So what is Bitcoin? Bitcoin is digital money. And in order to understand Bitcoin, we first have to start with what is money. And money has two properties. It is a store of value and it is a medium of exchange. And if you go all the way back to ancient Roman times, every single money has served as a store of value and a medium of exchange. Now, ultimately, the things that have served as money have evolved throughout the years. So we had everything from precious metals to seashells to paper, claims on commodities, all kinds of different things. But at the end of the day, money is a belief system, right? Especially in a fiat world. If you think of the US dollar, it is simply the belief between two people that that thing that is being transacted, that dollar that is being exchanged for a good or service has value. If the two parties do not believe that it has value, then it is not money because it cannot be used. If both parties believe, then it is money. So that is what money ultimately is. Money is a belief system. And what we've seen is it serves as a store of value and a medium of exchange. And so Bitcoin is merely digital money. If you think back before the internet, there was all sorts of analog businesses. When the internet came along, we simply took the idea of those analog businesses and we put it on the internet. We made some changes, we improved things, we made some tweaks, but what we did was we took business that existed in the analog world and we put it on the internet. We digitized the business. What Bitcoin is Bitcoin is taking the idea or concept of money and it is just digitizing or putting it into the digital world. Now, we've made a lot of improvements. We've made a lot of tweaks to kind of existing money to Bitcoin, but that's ultimately what we're talking about. It is simply digital money. And so how does Bitcoin work? Bitcoin works off of the same exact concept that Monopoly works on. So what I like to talk about is Bitcoin uses a transparent public ledger. And those are big fancy words that people use to try to sound smart. But what exactly is a transparent public ledger? It's simply, if you were playing Monopoly and you have four people sitting down in front of the board game, everybody sets up the board, you take the money and you put it out in front of you on the table, and then there's a bank. And that bank is a collection of all of the money that's not in an individual's, in front of them on the board. And the reason why there's only four people who are playing Monopoly, but you don't have a banker, is because there's full transparency in the game. So if I roll the dice and I pass go, I reach in the bank and I take $200. Everyone at the table can see that I took the $200 and I put it in my bank. If all of a sudden I buy a property or somebody buys one of my properties, the exchange of funds at the game is all done publicly and transparently for everyone to see. Because it's public and transparent during the game of Monopoly, there's no need for a third party or some sort of authoritative figure, right? When you're kids, you don't need your parents to sit over you and say, okay, Johnny, give the $200. It's just known that the four players at the table can understand because it's a public transparent system. Now, in the legacy fiat system, right, in the legacy finance system, almost every single transaction that occurs, whether it is with money or other financial assets, there is a centralized third party. All that means is if I want to do a transaction with you, I take the asset that I have and I go to give it to you, but I can't give it directly to you. I have to give it to somebody else who gives it to you. They process the transaction. And so ultimately what you and I are doing when we enter into a transaction or an agreement is we are trusting that that centralized third party is going to do what we want them to do. But in some cases, they don't do what we want them to do. They may go rogue. They could steal. They could do something that they claim that we don't fit their profile, and so they don't want to process the transaction, all kinds of different things. But one of the points of failure in the legacy system is that we have to trust this third party, this centralized system. Bitcoin, one of the improvements it made was the public transparent ledger. And that public transparent ledger meant that nobody had to trust a centralized third party. I now can transact directly with you across the Bitcoin network, and no one or nothing can stop us from transacting. It is a fully decentralized system. Decentralized just means nobody's in control. So a lot of people, when they hear that the Bitcoin system is decentralized and no one's in control, the first question is, well, how does that work? So essentially what is going on is Bitcoin was launched on January 3rd, 2009. And when it was launched, every single transaction that has ever happened is on a public ledger, right? If you go back to the Monopoly game, it would be like every time there was money trading hands, either from the bank to a player or from player to player, there was one of the players sitting there and they wrote down the transaction. So Johnny gave Sarah $200 and they wrote it down on a piece of paper. On the next line, Sarah gave Anthony $100, right? And every single transaction just got written down. But after 10 minutes of playing, we said, wait a second, rip off that piece of paper from the notebook and put it to the side. That would then start us writing down the transactions for the second 10 minutes of the game. And if every 10 minutes we ripped off the piece of paper and simply stacked it on the last piece of paper, at the end of the game, we would have an entire pile of paper where we could go back and we could look at every single transaction that happened in the Monopoly game. And we could even go to the exact time. So if we said, hey, between 7:10 p.m. and 7:20 p.m., I think I gave you $300. We could go back in the transactions and we could find 7:10 to 7:20, and we could find that exact transaction written down. That's what the Bitcoin blockchain does. And that's a very overgeneralized example. But ultimately, what the Bitcoin blockchain does is every single transaction that happens in about a 10-minute block gets written down digitally, and then it gets blocked together. So there's a block, right, or a group of these transactions, and it's kind of tied up in a 10-minute block. And then that block is tied to or connected to the last 10-minute block. So the Bitcoin blockchain is simply a chain of blocks that hold transactions in them. And each block contains about 10 minutes worth of transactions, and they're all just chained together. So the 10 minutes that's occurring right now, when it's over, we will take all the transactions that happen in that 10-minute period, and we're going to chain it to the last 10 minutes. And you can go all the way back to January 3rd, 2009, and you can see every single transaction that's occurred. So part of the beauty of this system is not only that nobody owns it, nobody controls it, but also that anyone in the world can go and see every single transaction, right? Again, it's a fully public, transparent system. And so this entire idea of Bitcoin is built on something that people refer to as trustless. And what that means is you don't have to trust the system. You don't have to trust a centralized third party. You actually don't even need to trust the person that you're transacting with. Everything that you need to do, you can verify, right? There, you can go and find the truth. And what I mean by that is when I send a wire at a bank, I'm trusting that the bank's not going to take my money, that the bank is actually going to give it to the right person, and that the bank or the recipient's bank is going to accept the money. So I'm trusting multiple parties in that transaction. Here, I don't have to trust anybody to send it. I don't have to trust anybody's bank to receive it. And I can actually go verify that the money was sent, right? The Bitcoin was sent, and I can verify who received it, how much, and I can even see what they do with it. And so when you kind of go through this system, it is a public, transparent system that is not owned by anybody. It's fully decentralized. And so a lot of people will say, okay, well, how is that run? How does the transactions get processed? If you're processing transactions, you need some sort of computing power to do that. You're right. It's in the Bitcoin system, there's something called Bitcoin mining. And you can think of the miners, all they are doing is they are processing transactions, right? They are there to run the Bitcoin software in a very generalized manner. And what I mean by that is they essentially have specialized computers that are very high computing power, and they run the Bitcoin software and they process transactions, and they're financially incentivized to do this. How are they financially incentivized? Well, there's only 21 million Bitcoin, so there's an artificial supply. There will never be more than 21 million Bitcoin. And in the beginning, starting in 2009, every 10 minutes, 50 Bitcoin were released to everybody who was running the software. So that 50 Bitcoin that was released in the first 10 minutes went to everybody who was running the software. Now, not every single person got 50 Bitcoin, but it was split up among everyone running the software. And so the next 20 minutes or the next 10-minute block, so that's kind of 10 to 20 minutes, now everyone running the software got access to 50 Bitcoin, right? And it got split among everyone running it. And so that has continued since 2009 all the way up until today. But the one thing that happened in the Bitcoin system was that it was programmatically designed for that 50 Bitcoin per 10 minutes. That's called the Bitcoin reward. That 50 Bitcoin per 10 minutes gets cut in half every 4 years. So it started out at 50 Bitcoin. Every 10 minutes for 4 years, 50 Bitcoin was distributed to everyone who was running the network. After 4 years, it got cut to 25 Bitcoin. Then for 4 years in a row, 25 Bitcoin was given to every single miner. For 4 years that happened, and then it got cut to 12 and a half. And so every 10 minutes for another 4 years, 12 and a half. In May of 2020, it just got cut from 12 and a half to 6.25 million or 6.25 Bitcoin. And so that 6.25 Bitcoin is distributed to miners every 10 minutes. That is their financial incentive to run the Bitcoin software and process the transactions. The beauty is that you can actually find truth one of two ways. You can either rely on a centralized third party. They're in charge. They're the authority. They have all the power, and they tell all of the participants in a market what is true and what is not. If the bank says that you did something, then you did it. If the bank says you didn't do it, then you didn't do it. You have no way to tell the bank anything, right? If all of a sudden the bank, you went to the ATM tomorrow and the bank said, nope, you don't have $5,000 in your account. Now you only have $1,000. How would you prove that you had $5,000? Right? It's a centralized party. They have control. That's where the risk is. So one way to get to quote unquote truth is to have a central party tell people what the truth is. The other way to find truth is to have consensus among 51% or more of a very decentralized distributed network. And that's what the Bitcoin system does. The Bitcoin system has millions of nodes all around the world, completely geographically distributed, and they all work together to find the truth, right? To process the transactions and determine truth. And so that is the beauty of the Bitcoin system, is that it is fully decentralized, fully distributed, and it doesn't rely on any centralized third party. So why is this system important? Today, we have two financial systems. We have the legacy finance system that relies on a fiat currency, the US dollar, as the core unit of account. And that core unit of account has a monetary policy that is inflationary in nature, meaning that they constantly produce more of it and it devalues over time. Since the early 1900s, the US dollar has lost 95+% of its purchasing power, right? So what $1 could buy 100 years ago is much, much more than what $1 could buy today. So you need many more dollars to buy the same amount of goods or services that you needed 100 years ago. That's because it's inflationary in nature. Bitcoin is 180-degree opposite. So the second financial system, or the alternative financial system, or what people call the Bitcoin system or the digital finance system, is all based on a deflationary asset. And all, again, big fancy finance word, all that means is there's a capped amount. There's only 21 million Bitcoin. About 18.4 million Bitcoin have already been put into circulation through that Bitcoin reward that we talked about, that mechanism. And so there's still just about 2.5 million Bitcoin that are going to be distributed over the coming years and decades. And so in a deflationary system, what that means is that the asset, the core unit of account, a Bitcoin or a fraction of a Bitcoin, will continue to increase in value rather than decrease, because supply and demand economics tell us if you have a fixed supply of an asset and demand increases, then the only thing that can happen is you could either try to produce more of the asset or the price has to go up. Because Bitcoin can't be recreated, no one's producing more Bitcoin, that means that the price continues to rise. Bitcoin has grown in US dollar terms at a compound annual growth rate of over 30% for many, many years now. And so the deflationary nature or structure and design of Bitcoin is 180 degrees difference. It's the complete opposite of the inflationary fiat system that we all have grown up using. Now, Bitcoin, because it's still injecting new supply, right? There's still a daily incoming supply. There's 900 Bitcoin per day that are put into circulation that are net new to the system. There's only 21 million total, but the circulating supply gains 900 a day right now. That means it is a disinflationary system or a disinflationary monetary supply. All of that means, again, big fancy words in plain English, that means that you've got a certain amount of Bitcoin that's created every day. Before May of 2020, that was 1,800 Bitcoin. It got cut in half. Now it's 900. In 4 years, it will get cut in half again, and it'll go from 900 to 450. So dis means it's going down. Inflationary means you're adding some to the circulating supply. So it's a disinflationary monetary supply schedule that is built in a deflationary monetary structure or design. And so Bitcoin, being a deflationary structure and complete opposite of the fiat system, provides an alternative.
Well, obviously, a lot of people have seen from the news that Elon Musk tweeted out that they were no longer taking payments to, pay for their Tesla sales, and they cited reasons that Bitcoin was, very, very fossil fuel heavy in its network, and so in that view, there was someone who was relatively respected amongst technology actually validating a lot of one of these FUD points that the mainstream media have been throwing at Bitcoin, which I don't think is actually valid, but nevertheless, it sent a shockwave of fear through the market. The price started plummeting within seconds to minutes of that tweet. And the market setup at that point was already quite soft. It was making a light recovery. It was tentative, and it was starting to move upwards. And that's also from a fundamental lens when you look at what was happening on the investment activity on the blockchain. And then when that tweet came out, it instigated severe amounts of selling, not only on derivative markets and spot markets. We actually saw like significant sell-off as coins started to flow into exchanges. So real coins got moved, and they were moving from wallets that were quite young. The coins held between 1 to 6 months of age, so relatively new comers to Bitcoin is what I can tell. And I think a lot of them saw a lot of really nice rises in Bitcoin from the 20,000 up to the 60, in the 50 to 60 range, and they probably took the opportunity to take profit. And so we saw this huge, I just call it tidal waves of coins moving into the exchanges, and ultimately the whole derivatives market started to unwind. Anyone who was long got liquidated, so that added further selling pressure, and so just we had this cascade of complete unwinding and sell-off, and what I think it went down to 30 or 29,000 in the final, when the final dust had cleared, and it bounced up, and then it was recovering. And then China announced that they were banning Bitcoin miners and reiterated their stance on no trading for their nationals. So, and that's a big thing because miners are heavily located in China. So that sent another wave of fear, and price sold down. So we're now in this situation where Bitcoin's heavily discounted below fundamentals, and the market's, attempting a recovery. It's going sideways upish now.
Raphael, what do you think?
Yeah, I second most of what Willie said. I think there is, from my perspective, two major driving forces here. I think I don't remember when's the last time when I saw the market react so much to news, to actual FUD, or to tweets. I think I saw this much more happening in 2017. So with Elon Musk, with the news from China, mines shutting down, China, banning mining and so on and so forth. On the one hand, that and what we saw on chain is that most of those reactions were to like more new market entrants, right? Very short-term holders that sold at losses, or actually panic sold eventually. And the second thing I think is that the market was just highly over leveraged, right? And I think that what Willie mentioned, this cascade of margin calls and liquidations, investors, aiming to buy the dip, when in fact, the sell-off wasn't over yet, and so sort of like cascaded down, and we saw that huge drop of over 50% down to 29K. So that combination, I think, is what really made all this price action happen.
I totally get that the market is not rational. And yet, for the Tesla news, I mean, it's not like a huge percentage of Bitcoin transactions were being used to buy Teslas, and Tesla kept all the Bitcoin on its balance sheet, other than what it had sold previously to Tesla liquidity in the market, which I think was just them trying to do fancy accounting tricks. But anyway, so in that sense, it's sort of the reaction to sell based on the news doesn't make sense. And is it just that that's what it is? These are newbies and what they're doing doesn't make sense? Is that why that tweet had such an effect?
Yeah, I think it's very much that case. It's like we've got some new entrants. They've only been holding for less than 6 months. And then you've enjoyed a lot of price gains, and then something comes along and it validates, so-called Mr. The Iron Man guy that has space rockets and Tesla cars says, no, this is solid. It's like, this is like, it's going to be a big contributor to the world carbon emissions. So, it's just the guy saying it is very well respected. And for sure, like that will, I think, well, it obviously did change the views of people that came in recently saying, oh, maybe this is something that's not going to work in the long run. And they emptied their bags and sold off.
Yeah, I think the simple reach of of a personality like Elon Musk just is something that we hadn't seen before, right? And I can very well imagine that it wasn't just the inability of many investors to see the nuances of those messages, such as, hey, we're not accepting these anymore because of X and Y reasons, but actually we haven't sold and we don't plan to sell any of those. And other investors that I bet we're betting probably on an irrational market reacting to this and saw the opportunity and started selling there.
Well, so here's one area where I actually disagree with you, Willie. Where you said you don't think the environmental issue is such a problem for Bitcoin, or not even just Bitcoin, but proof of work chains in general. Granted, I used to cover the environment as a reporter, so maybe I'm kind of tuned into that segment of the world a little bit more than the average person, and perhaps in that regard give them more weight than they have. But I feel like their concern is only just growing because, obviously the more time we let lapse without doing anything about it, the worse the problem will be and the harder it will be to fix. So in that regard, I actually feel like that could be quite a concern for Bitcoin going forward, but you seem to really not think it is merited.
Yeah, my training is a mechanical engineer. We studied renewables, and the thing is, the cost economics of renewables is still in its rollout stage, and it's very marginal. And so, what Bitcoin does is it makes something that's marginal cost competitive. And so, in some regards, you might see an old coal-powered station that's going to be shut down, but along comes a Bitcoin miner says we can mop up that energy and make it hang on for longer. But there's so many places in the world where renewable energies is deploying, and a mining setup can make that marginal deployment come about much sooner as the cost of renewables start to drop. And we're on this arc where renewables are becoming cheaper and cheaper. So eventually this whole infrastructure of energy that the planet's on will eventually move to renewables. Like the age of fossil fuels is coming to an end. And so what I see is that like you've got this tool here that's making things that are marginal, mainly renewables, and it's going to accelerate that. So that's the argument. And people see these smokestacks and go, "Oh, that's bad," but they don't see this this increase in acceleration of renewables that's facilitated by these new economics. And not to mention that the efficiency of the Bitcoin network gets better as it gets bigger per capita.
What comes to mind first? Is it a lock? Is it a door? Is it a wall? Is it a safe? You think of physically restricting access. Maybe if you're an information security professional, when I say security, you think of a firewall, an inspection device, systems that control access. When I say trust, you probably think of a friend, a person who's dear to you, someone who you have a personal connection. We associate trust with people who are in our local surroundings. And when we try to engage with more people than our local surroundings, our brain starts playing weird tricks to us, just like the statistical bias I talked about before. We trust people who have the same background as us. We trust people who look like us, because evolution has taught us to trust our tribe, because that's a mechanism for survival. And in a modern society, that type of cognitive bias leads to horrible outcomes. Racism, sexism, discrimination, ageism, ableism. You start looking at people and making judgments about trust because your brain is wired to make these mistakes, to use these shortcuts. It's an efficiency machine that does pattern matching. And these patterns are easy and obvious, and you've learned them from birth. It's a very bad model for trust, and it's the only model we have. So when we operate in a society that's greater than about 100 people, we have new models of trust. We have to find other ways to engage with others, other ways to trust, to extend trust to a bigger circle. And what do we do for that? We use intermediaries. We use trusted parties. We trust our bank to protect us from somebody else's check or payment bouncing. We trust authorities. We trust organizations and institutions to operate through a series of rules and policies and build trust for us through that institutional model. And that model is flawed too. It scales a bit better, but it does something very, very dangerous, which is it gives power to that intermediary that acts as our trusted third party. It gives power to the financial services companies and banks that act as intermediaries of trust. I'm Greek. That trust doesn't go very far in my country. But my country is not unique. I can name 24 countries that currently, if you say, trust your bank in an audience this size, the laughter will go on for at least 10 minutes and I won't be able to finish my talk. Trust your government. Germans can say, jawohl. 80% of the world goes, ha 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 ha. I'm not going to trust my government. They're a bunch of crooks. Probably worse than the bankers they appointed. Trust in intermediary institutions also doesn't scale. It doesn't allow us to solve the global problems we need to solve. Each of these institutions has a narrow jurisdiction. It can only operate within the confines of one country, and the norms are different in each country. So trust doesn't scale with the models we have. It affords too much power to the intermediaries, power that corrupts and leads to them abusing this power. Ask someone in the US how they feel about trusting the police. You don't call the cops in the US. They're more likely to shoot you accidentally than to solve the problem. Trust in power is a dangerous thing in a modern, scalable world and a globalized economy. Let's think about the models of trust we've got used to for years and the model of security we've had for years. If you visit European cities, you will see one of the tourist attractions is to visit one of the gates, the Brandenburg Gate, or maybe a gate that's at the outskirts of Paris, one of the 11 gates or how many there are that ring Paris. Do you know what those gates are? They used to be actual gates in the medieval wall that surrounded the city. In medieval cities, a wall was security. That's how you keep the barbarians out. You build a wall. The Great Wall of China, the Great Wall on the US-Mexico border that will never be built, and thank God for that. Walls are the model of trust and security that we've had for millennia. And walls fail. And the reason they fail are not because of ladders, although that's also a use, or catapults, or airplanes. The reason they fail is because of trade. Because if you build a wall, you need gates. And those gates need to be open most of the time so that people can come into the market and sell their wares. And if you are under siege and you close the gates, you have a matter of months before everybody inside starves. And if you close the gates because you don't like the people who are outside, the really interesting and vibrant market will be the one that emerges ad hoc right outside the wall. Your marketplace is now outside, not inside. Walls have failed in our modern society because of trade, because we need to move people, move goods, and move value in and out of these globalized cities. So what do we do when we create an information economy on the internet, when we create a new environment for us to trade ideas and trade goods and trade value? We make walls. Only this time, we imbue them with fire, and we call them firewalls, which is very impressive sounding until you actually see one, and it's just a black box with one LED. And what does a firewall do? It creates a barrier to entry. And it replicates the model of a medieval city. You have an inner core, a trusted center, where corporate data goes to die, to become stale and useless and uncollaborative and unshared. And there's a very nice firewall protecting that core data, but you can't actually use it. Because in order to use it, in order to share it, in order to collaborate, you have to open a gate. And as soon as you open a gate, all of the bad things flow through the gate together with your employees who went on a vacation and took their laptop with them and came back with 17 Trojans, 3 viruses, and a porn toolbar. And now they put that laptop right inside your corporate firewall, and guess what you now have inside? The barbarians are through the gate. So what do? Do you close the gate? No, we build concentric circles. An inner circle, a medium circle, a bigger circle, an even bigger circle. You have your corporate confidential data, then you have your intranet, then you have your wiki, a bit broader, and then you have the open public systems. And just like in a medieval city, when you close the gates, the market ends up growing outside the wall. All of the interesting things, all of the value creation, all of the content, all of the open source code, everything is happening outside your walls, outside your firewall. It's happening on GitHub under open source licenses. It's happening on Wikipedia. It's happening on the great open spaces of the internet. And your company isn't participating in any of it because you're too busy hiding behind the wall, scared to connect to the broad internet. When I started consulting about the internet in the 90s, this was the biggest challenge to explain to companies. And they would ask me, how can we open ourselves up to the internet? The internet is full of pornographers, criminals, terrorists, and scammers. And so here we are today, and we now have a new model for trust and a new model for security. And this model is not closed, and it doesn't use walls, and it doesn't use gates. It's the open public blockchains. And they develop trust by giving a platform that can mediate without being under the control of any organization or institution, that allows individuals to scale their trust to people they don't know because they can trust the rules of consensus, not each other. And they will have settlement of their transactions and verification of their data by a neutral platform that is not controlled by anyone, by an open, public, transparent platform that is not controlled by anyone, by a censorship-resistant platform that even though totalitarian states hate, they cannot shut it down. They cannot stop it from operating. You can't take Bitcoin out of your country, but you can take your country out of Bitcoin and not share in the benefits. And that applies to every open public blockchain. These are resistant to censorship. They're resistant to control. They give us a transparent platform where we can build trust. Trust between individuals, trust between organizations that are collaborating, new open forms of collaboration, ad hoc companies, decentralized autonomous organizations, work collaboratives, charities that are transparent and allow us to track the spending of money across the world, international payments across borders without controls, without censorship, without the privilege that all of us in this room share to not only have a bank account, but even more importantly, to have an ID that is well documented and to be a full member of a society in which we are not a hunted illegal immigrant or a refugee or a suppressed minority or a woman in a country that is not allowed to own property. And the blockchain sees none of that. It's completely invisible to these platforms because they are neutral. So instead of a model where we have a closed center, we have a model where everything is open and public and auditable by everyone, where security emerges not from the control of one institution, but from the collaboration of tens of thousands of nodes, each checking every result to verify it, and each coming together in consensus to say, this is the truth of the last 10 minutes. And I can't control it, but I can verify it. This model is going to change how we do trust and security across the world. It's going to change how we do collaboration across the world. It's going to change the nature of the modern corporation. It's going to change the nature of commerce and trade, because for the first time in human history, every human being on the planet has access to financial services without asking permission, without showing identity, without having to belong to a certain class or status, even if their government doesn't want them to have that, by the simple installation of an application. Software is the new form of banking. And a lot of you may hear the idea that these open blockchains are about making a one world currency. That could be nothing further from the truth. Or about allowing everyone to be banked without a bank, or to bank the unbanked, those who do not have access. And I'm here to tell you that what these platforms are here to give us is a choice to engage in a platform of trust through consensus that frees us to trust many and to scale our social organizations to massive levels and engage with the entire international population of humanity without barriers. It is not about banking the unbanked. It's about unbanking all of us. It's not about creating new trusted institutions. It's about creating trust without institutions. Trust through software. Trust as a protocol. Trust over IP. TIP.
Change things up some.
Well, I appreciate it. It couldn't have gone any worse just there. Literally, I heard the beep saying that you joined Zoom, and then my computer completely stopped across the board.
just remember, Ledger, there's no such thing as a coincidence.
That's right. Welcome to the show.
Well, yeah, Mark, multi-billionaire, entrepreneur, celebrity television personality, owner of the Mavs, king of the Shark Tank, and one-time cameo on Grace and Frankie season 6.
Yeah, fun.
And now, guest on Up Only TV. Welcome, mate. How's your day going?
Another day in paradise, bro. Just happy to be.
We've got so much stuff that we want to talk to you about, and we have a bunch of people in chat that are spamming things already. But I'd love to get straight into it. You've gone pretty deep on crypto over the last year or so, maybe last 2 years. You're like a NFT collector. You've been participating in DeFi. I heard you're even learning Solidity.
Yeah.
What was the inspiration behind this deep dive?
Well, first, my first company way back when, I wrote software and I did database applications and distributed database applications and did systems integration. So, I had a great database background. And so when blockchain started to happen, and I got familiar with it probably in 2012, but I was never sold on Bitcoin being a currency. And then fast forward as Ethereum and smart contracts in particular started to happen, I started paying more attention. And then DeFi summer hit. And I said, okay, I got to dig in some. And then NFTs picked up some. So I'm like, okay, I'm going to start minting some NFTs so I can learn. And that led me to seeing the royalty standard, which led me to believe that, okay, this is a game changer, which led me to believe, okay, I got to learn this shit, which led me to believe, okay, let's look at Solidity and smart contracts and realize they're not very difficult. It's pretty straightforward and simple. And from there, it was just all about the business applications and opportunities. And that's why I really dove in. And so, I've been up to speed on it for a while, but I've been hardcore only for the last 3 or 4 months.
Yeah, that's good. One of the things that we got a lot of tweets about was a comment you made about Bitcoin way back when, and I looked into the actual quote, and it's actually a lot more balanced than it was is often re-reported as.
Wait, you saying the media took something out of context?
Never.
Yeah. Maybe it happens once or twice. And it was a lot about your doubt in Bitcoin as a currency and seeing it more as I think the actual quote said something like, if they start printing money like crazy, maybe it's got a chance of an inflation hedge or something. I think it was 2013. How do you see this Bitcoin narrative now versus the Ethereum narrative? How do you see them going into the next few years?
So a couple things. Where people got mad at me and where I was at odds with the Bitcoin community is I never saw it as a currency. I saw it as a store of value, digital gold, right? And just a supply and demand issue. And obviously, the algorithmic scarcity is built just to define supply. And the more demand you can build for it, the higher the price is going to go. And that's not a bad thing, but it was never really designed to be a currency. And you saw that in 2017 with all the forks and all the arguments about block size and everything. And so I was fine with it as a store of value. And really just, to me, it was just a question of when it started becoming more commonplace for people to buy it, because that's what was going to lead to a significant increase in price. And that's what happened. And then with Ethereum, I really, with the ICO blow up and the ICO, balloon, it was interesting. And I actually lost some money at that time, just experimenting with some things, but nothing horrible. But I learned some there, but it really wasn't until this summer when smart contracts really started to evolve and become more available that things really took off. And that's, like I said before, that's where I dug in. And to me, in terms of how it all plays out, Bitcoin's great as a platform, and it's accepted now. It's an alternative asset. It's going to replace gold in the portfolios of a lot of people. And that hopefully will push the price up as long as the whales continue to hodl. But that's a different type of platform, and its utility really only happens when you wrap it, at least as of now.
I've thought that the replace gold concept has really started to click because you start to ask people, if you're under 30 or if you're under 40, you say, hey, you want an ounce of gold or the equivalent in Bitcoin? The answer is pretty obvious for most people. So there's this generational effect. What do you actually think is a realistic timeline for that to occur? Do you think it's a market cycle thing? So this market cycle, maybe it can get to 25% of gold, or do you think it's just going to be all at once at some point and all of a sudden Bitcoin's bigger?
It's going to be gradual. So you're starting to see these ETFs pop up and ways for people to buy it. And so, it's too difficult still to get money into a wallet just to buy Bitcoin. So you need to have somebody that you can work with that is going to hold it for you, right? Because most people are going to be terrified of having, that Bitcoin in their own custody, and so until that's simple, people are going to want to buy it through traditional means, through their broker or Robinhood, even, Coinbase to a lesser extent. But just that process of going through the know your customer AML stuff and connecting to your bank, it's still too much of a hassle right now. I mean, it's just easier for people to deal with a stock brokerage. But as there's more and more opportunity for people to buy from the people they already have their savings with and their retirements with, then you're going to see it chip away at gold, because the reality is gold is sold off a narrative just like Bitcoin is, and it's really built on trust. Do you trust gold or do you trust Bitcoin? And like you said, younger generations, are going to trust gold. I mean, I'm going to trust Bitcoin rather, because gold has no utility in and of itself. What's gold good for? Yeah, it's good for nothing.
Yeah, for sure.
Yeah, gold is dead. I got to track back. You lost money on 2017 ICOs. I love this. Like, you got to tell us what shitcoins you were buying, man.
No, I'm not going to. Normally I'd say I don't want to embarrass other people, but in this case, I don't want to embarrass myself. And so out of my mind. But yeah, it was not fun.
Is there like a billionaire WhatsApp group where you're like, bro, check out this new ICO, Dentacoin. It's the coin for dentists. It's going to go to the moon, and you like send each other the shit. Yeah, no, not really like a Telegram or Discord, but there's like a bunch of us on Snaps, and we just do streaks all day long.
That's
so
amazing.
Every night I send Bill Gates the streaks, and Warren Buffett gets my little S for streaks. And and then Warren Buffett always likes to show his toes and stuff like that.
What?
Chamath, is trying to get in the group, but Bill Gates won't let him in. So it's just like,
So you're saying there's like a secret billionaire Snapchat group that you're
Pretty much.
unveiling to the world?
Pretty much, yeah. So it's all the dudes, because there's all this competition to get into the New World Order and the Trilateral Commission, and they won't let normal people in, right? You got to be. So we decided to have our own alternative, and that was just a Snap group.
Looking forward to the Twitter account Buffett's Toes.
Yeah, I can't wait for the fake tokenized membership on Uniswap.
So everybody knows that you've come around in terms of crypto as a whole, but then you got excited with DeFi and with NFTs. One of my favorite NFT examples is one that you gave on an interview where you talked about, hey, why can't Mavs tickets in the future be NFTs? And the reason I love it is because it's totally vertical. You have control of that. So it's not a government, red tape type of issue. You have control, and it's a use case outside of the art world that is a win-win for customers and owners. Can you talk about how far you think NFTs can go?
Yeah, I mean, look, the whole collectible thing is just proof of concept for smart contracts. Period, end of story. Because the real money and the real opportunity is going to come from business applications. Things like DocuSign, forget about it. It's going to change, right? Insurance applications. I'll give you the perfect example. So there's a company, and I forget their name, that they have an insurance application that always just checks out an oracle for the National Weather Service for temperature and precipitation. So for the Mavericks, we had some crazy weather in Dallas a little over a month ago where it was like below zero and we had a few inches of snow and everything closed. So I could have bought some insurance on a smart contract that said, if the temperature in Dallas goes below zero and we get more than 2 inches of precipitation, then pay me, how much does it cost? And you pay me this amount. Well, that's completely different than traditional insurance because it's all driven by a smart contract. It just naturally checks every 30 minutes the National Weather Service. And if it clicks and it's below zero and more than 2 inches of snow, it just pays right to my wallet. That's the type of application you're going to see more and more of. And then you're starting to look at, like we were talking about optimism and the way they do things. Imagine if for health insurance, for claims against your insurance, instead of going through the disaster of trying to get your insurance company to try to pay your claim so you can get your money back, right, or stay alive, if there were a bunch of validators out there with a set of rules. And I think optimism's kind of approach is to look for fraud and for validators who don't do it the right way, right? So imagine if you had a bunch of validators that on an anonymous basis, you don't know who the person is, but just looked at the claim and authorized it or didn't authorize it. And if you got 80% of the people authorizing it, then your claim was approved and it happened in 6 minutes. Those are the types of applications that are just going to blow up. And tickets is just one more of them. Yeah. So, with tickets, in NFTs, the beautiful part of it is it completely turns upside down the secondary market. So if somebody sells, they're a season ticket holder for the Mavs, or a broker gets a hold of some tickets and they go into StubHub and try to sell it, we don't see any of it. And it's actually a pain in the ass because of the way the brokers do it. They'll list tickets they don't even own, right? All that stops. All that goes away when you make it an NFT, and then we can unlock really cool stuff. We can check to see if it's in their wallet, to see if we want to download something in game, to make sure they have it, to show that they're at the game. There's so many cool things that we can do. But like I said, the biggest and coolest stuff is going to happen in business and entertainment rather than arts and collectibles.
So you said that crypto now is like the early days of the internet, and with that vision you've just described, it seems like the next 10 years is like super exciting for crypto. Like people should be focusing on learning the space now. What sort of infrastructure do you think is missing to enable that vision to sort of become a reality? Like, what is preventing it today?
Well, there's not efficient connectivity between all the exchanges, right? So you get a lot of variability. You get a lot of musical chairs where, there's liquidity in one place, then the liquidity's gone, and then you bounce to another place, and people try to game the system in a lot of respects. And you get rug pulls, and you get all kinds of games getting played that shouldn't happen if all those indexes were connected to, or all those dexes were connected together. And so there's not the efficient market principle in play. And that's a challenge, because you can walk into you can have a token that right now is $30 and somebody sells, and 3 minutes later it's $16. And it's not that can't happen in the stock market. It can, but it doesn't matter where you are or how you're trading. They have to show you the best price.
So we bought our first Bitcoin in the fall of 2012, end of the summer, and I think they were around $8 or $9 a coin, so high single digits. And we've lived through at least 3 or 4 of these bull cycles, so this is pretty familiar territory for us.
I imagine it is, and I have to say right now, as we are recording this, just checked the live price, we're at about $32,000 a pop for Bitcoin. So does that price feel right to you? As investors who have been in this space since we were in the single digits, does 30,000 feel fair for where we are in the Bitcoin story today? So
we wrote a thought piece in August of this year, saying that we think the price of Bitcoin will be $500,000 or 500,000 per coin within the next decade. So we think actually even at $30,000, it's still undervalued. And we think Bitcoin overtakes gold within this decade. Whether that happens in the next year or 5 or 10, time will tell. But we actually think it's currently a bargain at $30,000. A bargain at $30,000 are not often words uttered on this podcast, so I'm glad to hear them here. Tyler, I'm curious to hear your perspective on the reasoning for this bid of $500,000 per coin for Bitcoin. Can you explain the reasoning for how you got there beyond just this is the next gold? Well, it really is about this is the next gold. If you look at the qualities that make gold gold, Bitcoin has those qualities or does better. So gold is scarce. The supply of Bitcoin is actually fixed. Gold's fairly portable, but you can send a Bitcoin around like an email. Gold's sort of durable, but Bitcoin's actually very durable because it's digital and it's math. So it's why we call Bitcoin Gold 2.0. We think it will disrupt gold. And the market cap of gold is $9 trillion right now. I don't know what Bitcoin's is, but for Bitcoins to be $9 trillion, each Bitcoin would have to be worth 500,000 a Bitcoin. So that's kind of how we back into that. We look at the market cap of gold and then divide it by what the price of Bitcoin would have to be worth $9 trillion, and we come out at 500,000. And why that's really important right now is it's because the money printing that's been going on really over the past decade, but that has really gone into overdrive with the COVID-19 pandemic. And I think something like the supply has increased, I think 23.5% in the past year alone, which is astounding. And the classic inflation hedge historically has been gold. If this was the 1970s, you would buy gold. If this was even a decade ago, you would buy gold. But now we have this digital version of gold that's actually better. And a lot of big investors are putting on the Bitcoin trade, and they're saying, well, gee, between these two, I see, one's this multi-thousand-year established store of value, and this other asset is this emergent store of value that offers an incredible upside in addition to protecting against inflation. And I think we're also seeing some companies actually buy it in their treasury, MicroStrategy being the biggest one. I think they've taken a $500 million position, and it's likely to be the trade of the decade. And it's all about basically protecting against the money printing that has been going on.
Absolutely. And we're going to talk in depth about this money printing, the Fed's role in this entire Bitcoin conversation. But I'm curious to hear your perspective here on why gold isn't going to be the next gold, right? An established store of value that's been around for thousands of years. It has been a valuable asset for thousands of years, should have staying power. What is going to diminish gold from being a store of value for people moving forward? Is it just not going to be as good a hedge against inflation as Bitcoin or other cryptos?
Well, I think the one of the challenges with gold is its hardware. It's actually really hard to move. And in a pandemic or some kind of disaster force majeure scenario, gold's actually not really practical. Bitcoin's incredibly easy to move. It's information. You can just send it through the internet like your email. So that's the first issue. The second piece is we're all living online, and Bitcoin is programmable money. So it's really built for the future of the online world. So those are two things right there that sort of make Bitcoin more attractive. Obviously, gold has familiarity, and it's in movies, and it's shiny, and we use it for jewelry, and people have grown up with it. But if you talk to Gen Z or millennials, they don't want gold. They want software.